Then next part is accounting concepts, conventions and principles. Very important one. Accounting is means of communicating the results of business operation to various parties interested in or connected with the business. Now, what is accounting? What it shows? Now we want to communicate, we want to share the results, the outcome, whether profit or loss of a business operation to various parties who are involved in a business directly or indirectly, like owners, creditors, investors, banks, financial institutions, government, and other various agencies. Now there are important accounting concepts. First is reliable financial information. So all the financial statements prepared by considering or following different accounting concepts should be reliable, or we can say acceptable. Second is uniformity in presentation. All the accounting concepts which we use should be uniform, should be similar, should be same. There should not be any changes in the format of accounting. Then third is generally acceptable basis of measurement. So here use of accounting concepts will enable accountants to follow all those accounting principles or bases which are acceptable, and they will follow generally acceptable basis of measurement. Fourth is proper information to all. The proper use of accounting concept will give accountant an idea to convey information to the important or concerned parties in the same sense they intend to convey. So whatever they want to convey, the accountant want to convey, they can convey to the important parties. Here the names are given to you. Fifth is valid and appropriate assumptions. So accounting concepts are useful to construct valid and appropriate assumptions. We can come to the conclusion with the help of proper accounting concepts. So let's see some important concepts of accounting. The first concept is business entity. This concept implies that a business unit is separate and distinct from the owner or owners. Now a businessman and his business will be different from each other. For example, your personal transactions are not recorded in the books of accounts except capital and drawings. Whatever business transactions you do, that is different. Whatever personal transactions you do, that is different. In the books of accounts, you will record only business transaction. Second is money measurement. This concept implies that only those transactions which can be expressed in terms of money are recorded in the books of accounts. So you don't record anything here except money. For example, you can't record strike done by employees, or if the employees are not performing in a proper manner, like inefficiency of employees, or if employees are performing very nicely, then you can't write efficient employees. Those things cannot be recorded in accountancy. You will just record whatever salary you are giving to employees. All things which can be measured in terms of money must be recorded here. Then there is cost concept. An asset is recorded in the books on the basis of the historical cost, that is the acquisition cost. So you will record the actual value of an asset when you purchase it. So for example, if you purchase an asset for rupees 10,000, so you will write rupees 10,000, and accordingly the value of that asset will get reduced. Now the reduction in the value is known as depreciation. That is okay, but always record the asset as per the historical cost. Then there is consistency concept. Any policy adopted for accounting should be continuous or consistent throughout the business, and it need not to be changed generally unless until circumstances demand. For example, there are different methods of depreciation. If you are using one method of depreciation, continue using that method only. Don't change the method in between. Then next is conservatism. While recording the business transaction, we have to anticipate no profit but provide for all possible losses. Now this means policy to play safe. Now for example, if a closing stock, its cost value is 10,000 and market value is 15,000. So the value of closing stock should be considered as 10,000 only. Always take the less value. Then next is going concern. It is a basic assumption that business is a going concern and will continue its operations for future. So here we will record all the transaction in the books of accounts with a prediction or with a assumption that business will continue throughout or say for a long period of time. So the business, we will assume that business will not close down in future. Based on this, business prepares annual accounting reports or pay taxes in advances, then purchase long-term fixed assets. All this happens when we assume that business is a going concern. Any short-term increase or decrease should be ignored. Then realization. Income is recorded only when it is realized. So it means that, for example, order of sale 1st April 2021 of rupees 50,000. So you got the order when on 1st April 2021 of rupees 50,000. Goods of rupees 20,000 sold and delivered on 1st June 2021. Receive cash on 1st October 2021. So as per the concept of realization, purchase is to be recorded at rupees 50,000 in the month of April 2021 when the order was received. So here it means that the sales revenue are considered only when sales are affected during the accounting period, irrespective of the fact whether the cash has been received or not. Same for the payment or same for the revenue part also. Then next is accrual. All expenses and revenues related to the accounting period are to be considered irrespective of the fact the revenue are received in cash or not, or expenses are paid or not. So here it means that if you are supposed to make any payment or you are supposed to receive any payment, irrespective if you have received in cash or not, or you have paid in cash or not, but you have earned that payment or you have to make that payment in that year, that is known as accrual. For example, if you are supposed to receive payment on 1st January but you didn't receive and the accounting period ended on 31st March, as you are supposed to receive that income on 1st January, it will be still counted in your income as accrued income. Then dual aspect. Now every transaction in accountancy will have two effects. This is very important here. Dual effect is the most important part in accountancy. So with the help of this dual effect, we will solve many chapters which are going to come in this subject. Then next is disclosure. The accounting report should be disclosed full and fair information to related parties. So all those parties directly or indirectly involved in your business should get relevant, reliable, comparable and understandable information or data about your business. Then materiality. According to this convention, financial statements should disclose all material items which might influence the decision of the users of financial statements. So here materiality depends on the amount involved in the transaction, like size of business, nature of information, need of the person making decision, etc. So all the important items or all the important information should be disclosed here. Then next is matching concept. According to this concept, revenues during an accounting period are matched with expenses during that accounting period.